Hello again from Core Wealth. We're going to be talking about the month of January, and I'll also be having a look at the year ahead. What are some of our expectations? The year started well from a market perspective, but was maybe a bit haphazard from a personal perspective. Schools going back and then not going back, and some restrictions being lifted, and when are they going to be lifted, those type of things. We will also have a look at what's so special about February, and I'm not referring to Valentine's Day. In financial literature, there's something called the January effect, which says markets tend to run more often than not in January because as people come back from their Christmas holidays, there's more energy and new start to the year, and that tends to push markets up. If we have a look at January 2021, it was a good start to the year. We saw the South African equity market up over 5% just for the month. Emerging market equities as a whole also getting in fact closer to 6% for the month. Developed world equities not as strong, only up just over 1% for the month of January. If we look back over the last year, however, we've seen that the best place to have been was in emerging market equities, over 28% for the 12 months to the end of January this year. The South African equity market gave you close to 15% over that same period, and developed world equities giving you just over 15% for the year to end of January. Just again proving the point that you don't want to be out of the markets if you've got a long-term strategy, and this has definitely paid off in January. We saw the Rand weaken a little bit over the last month, and that really was because it was quite a bit stronger in December, getting close to 14.50 to the US dollar. At the moment it went back above 15 in January, but at the moment, at the time of recording, it's just below 15 Rand to the dollar. So the knock-on effect from markets onto our portfolios over especially the last 3-4 months, has been particularly positive, especially long-term portfolios which will have more growth assets in them. They will have more shares in them, a little bit more property, and the share side of things, as I've just said, has been a definite boost or tailwind for those portfolios, and therefore we've seen clients' wealth growing where they've had long-term focused portfolios. Again, just reaffirming that you want to stick to strategies. You can't even afford to be out of a strategy for 1 month, because it's impossible to time from 1 month to the next, as we saw in January, where equity markets in South Africa were over 5% up. There's something in markets called a CAPE ratio, cyclically adjusted price earnings ratio. Don't worry about the jargon, but essentially means if you have a low CAPE ratio, the share is cheap. If you have a high one, it's considered expensive. Now, we've taken some research which breaks the S&P 500, the US equity market, into 12 buckets, and you can see bucket number 1, low CAPE ratios, bucket number 12, ratios between 40 and 50. Currently the market sits in bucket number 11, it's at 33.5 times on a CAPE ratio. So at the expensive end of the spectrum. This data was then analyzed going back from 1900, so over 100 years ago, and saying, depending on which CAPE ratio you were at, what did the subsequent 10-year returns look like? And the graph we're showing you now shows the buckets along the bottom, and then the range of returns indicated by a green dot for the best return you've got over the subsequent 10 years, and the red dot the worst return over the subsequent 10 years, and then the average, the bar shows you the average real return. And you can clearly see the more expensive the shares were, in other words, the buckets more to the right, the lower the prospective returns were, or the returns over the next 10 years. We currently think that the US market's expensive, and therefore are underweight that, and there are other markets around the world where we see better prospects in terms of future returns, and emerging markets is one of those. There are opportunities in Japan as well, and even in some areas of the US, but not in the broad market per se. When investing in bonds or fixed interest instruments, you're looking for the best yield or interest rate. Think of it, you go to the bank, you want to go to the bank that's going to give you the best interest rate on your money that you deposit there. Now, this graph that we're showing you is the yield on the US 10-year bond going back over 200 years. And what you can see at the moment is that yields are at their lowest they've ever been in the last 2 centuries. If for a developed market investor, they are saying, well, where can I find yield or interest on my money? And one of the places they can find that is in emerging markets. And this graph now shows you a number of the emerging markets and what sort of yields, real yields or yields above inflation, you can get on their bonds. Now, some of those countries are more risky, and so they wouldn't be necessarily attractive for investors, but a number of those emerging markets are places that investors would be interested in going to. And South Africa is one of them, and there's a number of other emerging market countries there that we think are going to benefit from this demand for extra yield that can't be found in the developed world. Now, South Africa has its budget speech coming up now in February, and that will be critical for the world to see that South Africa is starting to get, or the South African government is getting its expenditure more under control and is actually spending money on things that will make the economy grow. So that's a key point to look out for in the February budget. Yes, Valentine's Day is in February, but that's not why it's so important for us at the moment. But please, guys, do get your chocolates and flowers and all those things ready for Valentine's Day. But for us, the 2 key things in February from a financial planning perspective are tax-free savings accounts and retirement annuities have to be done before the end of February if you want them to be included in this tax year. So just a quick refresher, tax-free savings accounts, you can allocate 33,000 Rand a year to them. Any returns or growth you achieve on that investment forever will not be taxed. And it's a very nice vehicle for long-term investing and often suits parents who are wanting to save for their children, or grandparents who are wanting to save for their grandchildren who are maybe still young, and by the time they use their money they would have had some really good growth on it and would not be taxed on it. The retirement annuity, similarly, you can allocate 27.5% of your taxable income to a retirement annuity, up to a maximum of 350,000 from a tax deduction perspective. So all of that needs to be done before the end of February. So if you haven't done it, please get hold of us. We'd be able to assist you to get that all sorted out. We are looking forward to this year. It will have its ups and downs, there's no doubt about that. But our strategies, if anything, last year has proven that they've worked, and we are expecting good things in the coming years despite the challenges that we've faced, particularly from Corona. So if you've got questions, please let us know. It will be good to chat to you, and thanks for watching.